I'm listening. My matching number is 2617449. I'm group 17. My title is the relationship between domestic and foreign investment. Firstly is the introductions or background. Foreign direct investment has played an important and profitable role in several nations across the world. Asian countries have reaped significant benefits in recent years. In these years, many developing countries as well as Malaysia have increasingly used foreign direct investment as a source of capital, technology, management skills, and market access for long-term economic growth and development. Growing balance of payments issues as well as a drop in consensual aid have compelled several developing nations to reconsider their on FDI and they have taken significant unilateral efforts to liberalize their inbound FDI regime. Domestic investment is the investment in the companies and products of someone's own country rather than in those in a foreign country. According to a research commission by Standard Chartered, European and US corporations identify Malaysia as the second most favorable Southeast Asian country for chance to develop their sourcing, selling, or operations during the next 6 to 12 months. Among respondents who judged Asians to be the most promising growth zone, Japan lead the list 42% as the most attractive place for foreign investment, followed by China 36% and Australia 34%. Malaysia was placed 9, 3 notes below Singapore, which was placed 6 in 2020. Malaysia Investment Development Authority (MIDA) reported that the foreign direct investment in Malaysia stood at 64.2 million. Therefore, it is undeniable that FDI contribute to the Malaysia growth of Malaysia as well as the domestic investment. FDI is seen to be a key component in boosting export and economic growth. FDI is a significant component in Malaysia and other emerging nations, supplementing local investment and influencing economic growth. FDI drive technical advancement, benefiting both local business and consumers by giving chance for technical advancement. The influence of foreign direct investment to domestic investment in developing nations is unclear and is dependent on the motivation for such investment. One reason for such investment is to eliminate commerce due to host country obstacles. This type of investment would not result in an increase in domestic host country investment. However, if FDI inflows are driven by a country's comparative advantage, they can augment local investment and boost economic growth. Besides that, Ahmad Razali 2010 claimed that domestic investment have an impact on FDIs as well. Theory implies that domestic investment has an impact on FDI in numerous ways. Public investment in physical and human infrastructure is one obvious approach. The most development the infrastructure, the more profitable FDI will be. Another probable explanation is that domestic private investors have access to more precise information about the local business climate than do overseas investors. Therefore, in this paper, we will examine the relationship of domestic investment and foreign investment as well as the determinants of foreign investment in Malaysia. Other than that, there are a lot of data that obtained from different resources as from internet and journal. Classifying data into independent variables and dependent variables is the very priority to carry on this project paper. There are three independent variables we use to determine our topic, which are domestic investment, DI, gross domestic products, GDP, and foreign exchange rate. Next one is problem statement. Domestic and foreign investment might have significant complementary or substitution relations. Policymakers will frequently question if we should prioritize domestic or international investment initiatives. There is some debate on whether FDI crowds in or crowds out domestic investment. Besides, there are a lot of studies that concern about the effects of FDI on GDP, relationship between FDI inflows and export growth, as well as the determinant of GDP. However, it was lacked in the studies on the relationship between domestic and foreign investment in Malaysia. Meanwhile, domestic investment is not the only factors that will affecting the foreign investment, but also some independent variables should be considered. Thus, more observations and data should calculate to prove the corrections and reliability of this project paper. Next one is the objective of the study. The research objective of this paper is to evaluate the trend of foreign investment of Malaysia from the year 1989 to 2019. Meanwhile, the second research objective is to evaluate the trend of domestic investment in Malaysia. The third research objective in this project is to investigate the relationship between domestic investment and the foreign investment. Next one is descriptive statistics. Based on the data above, the mean of the FDI is 6.239 and the standard deviation is 3.791. That shows there is a small difference between them. Hence, all of the data are close with each other. The smoothness of FDI is positive, and then there is a right skew. The kurtosis of FDI is positive value, and then that is a heavy tails. In contrast, the FDI has the mean of 46.291 and the standard deviation of 25.672. This shows that all of the data are not close to each other. The skewness of the DI are positive, and then that is a right skew. The kurtosis of DI are also positive value, and then that is a heavy tails. Besides, both of the GDP and foreign exchange rates have big difference between mean and standard deviation. Thus, this shows that all of the data are not close to each other. The kurtosis of GDP and foreign exchange rates are positive value, and then that is a heavy tails. The skewness of GDP is positive, and then that is a right skew. However, the skewness of foreign exchange rate is negative, and then that is a left skew. Next one is correlation analysis. Foreign direct investment has the strong positive correlations with the domestic investment and gross domestic product, which is 0.8095 and 0.8012 respectively. However, the foreign direct investment and foreign exchange rates have small positive correlation between each other, which is 0.1595. Here is the multiple regression model. The intercept estimate beta naught equals to 5.852 on average if domestic investment, gross domestic products, and foreign exchange rate are 0. Then the predicted foreign direct investment is US dollar 5.852 billion. The value beta 1 is 0.025. Thus, if domestic investment increase by 1 billion US, expected foreign direct investment will increase by approximately US 0.025 billion. The value beta 2 0.026. Thus, if the gross domestic product increased by US 1 billion, expected trade balance will increase by approximately US 0.026 billion. The value of beta 3 is 1.544. Thus, if the foreign exchange rate is increased by 1 ringgit per USD, the foreign direct investment will decrease by US 1.544 billion. Next is R square. R square is 0.696. The increased 1 unit of independent variables, which are DI, GDP, and foreign FX rates, will increase 69.6 of variation in independent variable, which is FDI. T statistic for the individual significant T critical equals to 2.042. Since T statistic DI 0.0392 is lower than T critical 2.042, we reject H none. The test is statistically significant at the level of A level significant, thus TI is significantly affect the FTI. Since the T statistic GDP equals to 1.646 lower than T critical 2.042, we reject H0. The test is statistically significant at the N level of significance, thus GDP is insignificantly affected the FTI. Since the T statistic FS rate is negative 1.706 is bigger than the T critical negative 2.042 and P value 0.0994 is bigger than at equals to 0.05. We fail to reject the H0. The test is statistically insignificant at the N level of significance, thus foreign exchange rate is insignificantly affected the FDI. Next one is normally test. The probability value which is 0.058 is greater than 0.05. We will fail to reject null hypothesis, which is the residuals are normally distributed. The autocorrelation for its residuals given in the figures are generally small and insignificant. There is exception at leg 2, which is negative 0.538, where the autocorrelation exceeds the significant bounds. It is reasonable to conclude that there is no strong evidence of serial autocorrelation. The first autocorrelation R1 is equals to negative 0.047, and the second autocorrelation is R squared equals to 0.371 are significantly different from 0 at a 5% significant level. The null hypothesis is rejected. We conclude that the errors are severely correlated. Next one is LM test. The value of F statistic equals to 0.00085 and the LM S squared is equals to 0.001019. The value F statistic equals to 0.00085 is a stack of the significance of P, the coefficient of receipt -1. The P value of both T test and F test are 0.9769. Hence, the null hypothesis of no correlation is accepted at 5% significant level. Next one is statistic. The value of chi-square statistic is 7.554 and the F value is 2.8999, which are less than their critical values. Their corresponding P value are 0.0532, which are more than 0.05. Therefore, we fail to reject the null hypothesis of common statistic at a 5% significant level. The test is statistically insignificant, so the error term is homoscedastic. We conclude that the model is homoscedastic. Next one is multicollinearity. Since the VIF value of all variables are greater than 1, hence all of the variables shows the multicollinearity problem is exists. The FIF values of all variables which are 60.064, 18.01, 18.218 and 1.6258. Two of the values is more than 10. The collinearity among variables are comparatively high. In conclusion, foreign direct investment is crucial to the Malaysian economy. Based on the result, if the domestic investment increased by US 1 billion, expected foreign direct investment will increase by approximately US 0.025 billion. If the gross domestic product increased by US 1 billion, expected trade balance will increase by approximately US 0.026 billion. Besides, if the foreign exchange rate is increased by 1 ringgit per USD, the foreign direct investment will decrease by US 1.544 billion. The independent variables such as domestic investment and gross domestic product is significantly affected the dependent variable. foreign direct investment, the independent variable foreign exchange rate is significantly affected the foreign direct investment. Therefore, the result of the relationship between all of the independent variables and dependent variables is tally with the literature review except the foreign exchange rate. Therefore, it's time to review the investment policy for encouraging DI to increase the FDI. Facing the high competition from the neighboring country in attracting FDI, the policymakers shall provide a conducive environment to local investors. Domestic promotion and attractive packages such as tax incentive finance facility reduce the transaction cost and improve the delivery system by cutting bureaucracy and corruption can be launched. Besides, infrastructure is very important for attracting FDI. It will provide specialized markets and conducive conditions to the company due to the extreme low degree of risk and investment. A rebound infrastructure network promotes export either via direct channels or through intermediation as a feasible entry road. With the improvement in logistics system, the equitable flow of the company product in the target country will be stimulated, as well as the prospect of higher sales as distribution at low cost and adequate service. In the modern information society, the speed of technological advancement and diffusion is much faster than before.